Good afternoon, everyone. Our next session is clarity around financial performance. Would you please join with me in welcoming Wayne Lockhart.
Thanks, everyone. I might just stand down here.
You should come down here.
Yeah, right, why not? Yeah.
You should walk right that lady up in the back seat having lunch and make her come forward.
You get the first question. No, we won't have time for questions, but probably. But please feel free to come and see us at the John and I at the Profit Guardian stand if we don't have time for questions. It's my aim over the next 25 minutes or so is just to reveal to you a new way of putting clarity around financial performance. And we've done that by expressing the performance of a business as a score out of 100. And I'll reveal how we've come up with that over a period of time. And as an added bonus, how you can obtain an indicative valuation of any business from that score. It's an automatic byproduct. This is fairly revolutionary stuff. As I said, it's a new way, and how I'm going to approach it. I'll start with a little bit of history about me. I'll let you in on my midlife professional crisis. And I'll tell you a little bit about my history with business software, advisory software. I'll reveal the profit question that I always feared but no longer do, and also why I embarked upon doing this myself and with a small team of people. I'll give you an overview of the Profit Guardian scoring system and its link with business valuations, and hopefully leave you so excited that you'll want to know more and come to our demonstration sessions. We've got one demonstration session later this afternoon and one tomorrow. So we'd love to see you at that. Okay, well, I'm certainly nothing special. I've been in this game for 30 plus years. I stopped counting after 30. I just put a plus sign after it now. I guess I'll have to reconsider that when I get to the 40 years. But anyway, and I'm a chartered accountant, and I just run a small country practice, small general practice. So I did have some initial training in one of the big four, but that wasn't for very long before I went back to the bush again. And we just have a small team of people. It's a compliance-based practice. I did get out of audit some years ago, although I think the basic principles still remain in my head. At about 40 years of age, I did have this professional, or this midlife professional crisis. I don't know if I had the other one or not, but I just became, I guess, a bit bored in going through the annual rituals, and I wanted to get in behind the numbers. I guess I got a bit sick and tired of clients, their eyes glazing over when you'd put the financials in front of them, and you'd try to explain a bit more than just put a tax return in front of people, and more times than often I was trapped into speaking accounting lingo, which most people don't understand. And so I thought to myself, well, I really do want to communicate these numbers in a more meaningful way with my clients. And I thought, well, perhaps I should look at some software to help me start these conversations, get in behind the numbers, reveal something exciting, and start a conversation other than being purely tax-based. And so, for those of you with memories long enough, I first started off with software called Practition. And I think that was about $5,000 at the time. And and because it no longer exists, I suppose I can be critical of it now. I found it really, really difficult to operate Practition in a cost-effective way. Very labour intensive. It was weekly based monitoring. Admittedly, the software wasn't as powerful as it is today. And it was focused on gross profit measurement, gross profit rate. And the importance of the gross profit rate per hour, per week, per whatever, has remained with me as a pretty important metric. Then, I decided then to investigate another piece of software called Goalfix. And I think that cost me about $3,000. But of course, as you all know, you invest in the hard costs, but then you've got your learning time, which we tend not to put a price on. Goalfix, again, outlived its usefulness because naively I thought it could be appropriate to SMEs, but it was probably better suited to the larger corporates. However, as they say, there's no such thing as failure in life. They're all just learning experiences. And so out of Goalfix, I took the significance of rejigging a balance sheet so that the net profit before interest and tax is expressed as a percentage of the operating assets. Now, operating assets, I won't go into detail there because this session is just a presentation and not a demonstration, but very, very happy we'll be showing you that in our demonstration sessions. And it always really intrigued me that, when you retire and when you've got your super fund, you're always interested in the return on your investment. But people running their businesses day to day don't really seem to have that brought to their attention. And so I think that's rather ironic because the return on operating assets certainly links profit with asset utilisation. And I took away from that the importance of the DuPont method of rejigging a balance sheet. And behind the scenes, Profit Guardian automatically rejigs the balance sheet. And the third bit of software that I invested in was Profit Optimizer. Now, I no longer use Profit Optimizer. I believe it's still available, so I won't say too much more about that. And I decided, well, gee, where do I go from here? Do I give up and just go back to getting my thrills out of tax returns and not really. I always had a need to do. I just felt within myself that I wanted to do a bit more for my clients. You could call that, I guess, advisory services, business advisory services. Accountants still, we all do advisory services, bits and pieces here and there, and we're usually the first port of call for something financial, some problem financial a client has. So we are doing that. That's for sure, and always have done. But I guess I just wanted to better communicate these numbers. Now, I guess deep down I had a little bit of, I'm revealing a bit of myself here, and I hope it doesn't indicate to you that I'm all that much different or a bit crazy. I don't think I am. But I always had this being a tax agent, I've always had a bit of a problem with that. Given the blood, sweat and tears that we've put into our training, and being a quasi-employee of the tax office and being a tax agent, I thought, no, look, we're skilled to do more than that. We certainly are. We're better equipped than just to be form filler in us. And I wanted to extend that. And I thought, well, also for our audit clients, can we assist management more in what the numbers are telling us as auditors and accountants? I said I'd mention the profit question that I always feared. And, it could be said that accountants really do have a vested interest in keeping things complicated because, if the client's so confused, well, they're not likely to ask you hard questions. So that's the cynical side of me saying that. But I always feared the question, okay, you lay out the P&L on the desk with the client, and the client sees the profit, Now, we've all heard them say, where is it? We've all heard them say that. And what Profit Guardian does, as you'll see in the demonstration, it actually produces a cash flow statement, mainly in the form of the old source and application of funds, which I think tells a better story. It's a more logical story from top to bottom, fully reconciling with the bank account. That'll diffuse any questions about where's my cash gone. But the big question I always feared was, is my profit good enough? Now, ask yourself that question. If a client asked you the question, is my profit good enough? How would you respond to that question? And I always thought, oh, gee, I don't know how I could respond to that. Because it'll always come as a surprise, and therefore the best answers are less likely to be given when something's sprung on you. And you could say, well, it's better than last year, or it's worse than last year. But the client could still say, is that good enough? So I really felt in my own mind I needed a basis on which to express financial performance in a way that we could confidently articulate and the client could readily understand. Any client could readily understand. Mike, are you going to give me the heads up at 5 minutes?
Yes.
That'll be great. I've got this fear of running over time. So, how can we simplify the numbers, I thought? Well, I went to a Tax Institute conference in Perth some years ago, and I went a couple of days early so we could just do a bit of touring down south, and there it was, I think it was Saturday afternoon. Got the car at the airport, heading south, lovely sunny afternoon, and my wife's sound asleep, so there it was, just myself in the car. And I don't know what it was, whether it was the Western Australian Air, but I had this thought. I thought, well, look, most things in life are scored out of 100. Why can't we score financial performance out of 100? Everybody can understand that. And so then I thought, well, I'll stick with that idea. Well, that sounds fine in practice, but what are we going to score? So I started asking a few questions around my formal and informal networks. And the feedback I got from nearly everybody was cash flow, Wayne. You got to make cash flow one of your scoring components if you're going to do this. It's the lack of cash flow that keeps people awake at night. And right, cash flow, fine. Yep. And so I thought, well, another thing I think we should score is break even. And another thing I think we should score is return on operating assets, coming back to that original GoldFX DuPont methodology. And then came the question of how we're going to weight these scores. Well, I'll show you in the last 5 minutes how we weight the scores. But the important thing is not to get too hung up about the weighting, because as long as you're consistent over time, you really you've put a line in the sand and you're simply measuring performance, for better or for worse, from that line in the sand. So we started to do this in Excel, just for the practice, just for me and the clients of the practice, and then gave a presentation at a national conference, and that got some really good response. Although when I look back upon it now, I'm a bit embarrassed to see where we've come to, but that's what continuous improvement's all about. And then we thought, well, a lot of clients don't really get turned on by numbers. Learning styles differ, and a lot of people relate to pictures and graphics better than they do numbers. So we thought, well, Excel has limited ability in the graphics area, so we upgraded to VBA and started to do some nice stuff there. And then all that was all going swimmingly well, and so we decided, well, I think I'd like to share this with the profession, so let's go commercial. And so when I say let's go commercial, let's start to develop things with a commercial outlook in mind. I thought I'd better test this a bit further, so I had a coffee one afternoon with David Smith, and David's response was, Wayne, in a nutshell, it was lovely coffee and lovely chat, etc. But in a nutshell, David's response was, Wayne, many have come and gone doing what you're attempting to do. The waters are very muddy. Are you sure? Well, that certainly got me thinking. It certainly got me thinking. That was a nice dose of realism coming into my decision-making processes instead of idealism. And so it actually did. It did disturb me. I took that comment on board very, very seriously. And that was before what you see out there today in terms of product offerings. Anyway, I went back to my office and I thought long and hard about it, and I had a bit of an epiphany, I think. Yeah, that's one word for it anyway. I thought that if financial performance could be scored, surely there should be some correlation between financial performance and the valuation of a business. We know that to be the case. But surely, if the scoring is to be valid, it should be an automatic correlation, an automatic indicative indication, not a formal valuation opinion, but an indicative valuation opinion as a byproduct. And I ran into David at the airport, I don't know, a little while later, and I said, oh, by the way, I've thought of this valuation component. And he said, yeah, that's interesting. And so that was a nice little light on the horizon for me. So away we went with a designer. And fortuitously, I just happened to come across a guy locally that could write in the language, the software language that I was advised to do this in. And we decided at the outset that what we do has to be cloud-based. That was the future, and that certainly proved to be the case. Secondly, the software had to work straight out of the box. It's simply a matter of loading your financials in, and there it is, all finished, all pre-populated, reports, graphs, warnings, alerts, all pre-populated. You don't want to waste time, because the acid test is me. I'm using this in my practice, and so I'm as conscious as everybody else of the need to keep time and resources to an absolute minimum. The third criteria, it had to work across all entity types. I didn't want one set of hassles for sole traders, another set of different looking stuff for partnerships, another one for companies, and another one for trusts. Trust is where it really does get tricky if you want to do this properly. But yeah, that was part of the design criteria. And as I said earlier, it had to answer questions easily. You didn't want to go digging to find the answers. So, what time am I due to finish? 20, quarter to, 10 to?
10 to.
10 to? Okay, thanks, mate. Let's have that second slide, please. Thank you. That's the main page of Profit Guardian. And this is where we start our conversations from. When you see our demonstration, this will be somewhat clearer. This is simply a screenshot. And it was stressed to me that this afternoon has to be a presentation and not a demonstration. But I thought if I just talk to you with a blank panel here behind me about our componentry, it really may not sink in as well as actually seeing it. So it's a static shot, it's not live, the demo sessions will be live. I mentioned cash flow. Oh, sorry, I go back a point. I'll have one of two conversations with a client, and that is, what does the score tell you? I try not to go into consultant mode, advisor mode straight off. I really want to engender a conversation, and I find the best way to do that is to ask questions. What does that score tell you? What does that score mean to you? And you don't know what's going to come out of the client's mouth. You really don't. But that's good. That's good. You're there to have a conversation. And the second, if the scores, And sometimes I'll also ask the valuation, the indicative valuation. Do you reckon that's enough to retire on? If you had to close up business today, would that be enough? And you'll get some amazing responses. No, I couldn't afford to live. Obviously, it's a function of age and where a client is in their business and lifetime cycle. But that is a great conversation starter as well, because if a client says, no, it's not nearly enough. I really think I'm worth double that. Well, you know you've got some work lined up, because what the client's really asking you is, how can we work together to increase that value? Now, and what happens, of course, is that what they're really saying is, let's develop some strategies together. Okay, the componentry, I mentioned earlier that cash flow is highly significant, and we recognise that. We give that 50 points out of the maximum of 100. But we break cash flow up into components. And so all automatically free cash flow falls out, and that's simply the amount of cash that's available for the discretionary spend. The next component we look at is cash gain and drain. Now, that looks at your revenue growth or decline from one period to another, and it looks at how you've managed your linkages to revenue, what we call the revenue or sales linkages. Accounts receivable, variable overheads, cost of sales, stock, accounts payable. How have you managed those? Have you managed them effectively or not? And we'll show you in the demonstration how that actually happens. And the third component of cash flow is sustainable cash flow. Given that you've generated free cash flow, hopefully, given that you've got cash gains and drains going on, and those two are interlinked, because one is reflected in the free cash flow and the other in the cash gain drain, how sustainable into the immediate future are those cash flows? Because you can only collect debtors until they're zero, and you can't indefinitely delay paying creditors because they'll shut you up. And so sustainable cash flow is aimed at identifying, looking through the windscreen, as to whether or not our trend in cash flow management is heading for trouble or not. So, maximum 50 points, and that's all graduated. So there's no rule, and there's a materiality factor going on in the background where if something doesn't change by more than 8%, we're not going to worry about giving it a detrimental score. And so we want to, because the last thing you want to do is have a score that's highly volatile. From interview to interview, you don't want your dashboard going all over the place. So the more we can do to stabilise, to take shocks out of our measurement, the better. And I believe we've certainly achieved that aim. And the next component, margin of safety, that is simply the excess by which revenue exceeds one's break-even point. The higher the excess, the higher the margin of safety, the more secure the business, and arguably the more valuable the business, because it is less susceptible to the detrimental effects of a loss of customers. And the fourth component, return on operating assets. That expresses profit before interest and tax, EBIT, as a percentage of the core operating assets of the business. And one thing that Profit Guardian does is we strip core business from non-core. So if you've got an entity that might have a rental property, for example, as well as being a wholesaler or a manufacturer of something, we like to see, and in fact we insist, that the non-core assets be separated. That's because the value of the non-core assets has a different method of valuation. It has a different form of critical analysis. So we strip that. So profit before interest and tax is from core business assets. Now, and where appropriate, where our alarm bells are going off in the background, our warnings will pop up there for you to drill down upon. And there's the indicative valuation. So a business that gets 100 out of 100 gets an earnings multiple of 5 times. That's about what as we know, we max out in SME land. But if you're in a particular industry, e.g. pharmacy, where you might want to put in a lower cap rate, you can certainly do that. And the score, the adjusted score, there is an adjustment going on automatically behind the scenes to take out vendor-specific stuff, which doesn't apply in a valuation. You've also got the ability to put in valuation adjustments if you so wish. But the adjusted score is divided by the cap rate, and EBIT is multiplied by that cap rate to come up with an indicative valuation. And every good valuer will use a primary method and a secondary method of valuation, and just behind the scenes, which you will see in a separate screen, we run a calculation to see what the correlation coefficient is between the value that the business is adding from year to year and the earnings multiple that we're using. And in Stats 101, you would have learned that -1 is a completely opposite correlation, +1 is a perfect correlation. Anything from plus 0.6 to 1 is very, very significant statistically, according to a mathematics lecturer mate I've got at Sydney Uni. And our correlation coefficients are consistently running above plus 0.7. So it gives us extra confidence that the earnings multiple indeed has legs. Now, I think time's up.
Just about.
I've got 2 minutes max. Is that okay?
Yep.
Please feel free to come and see John and myself at the Profit Guardian stand. I do realise that it's probably only practitioners that want to get behind numbers like I wanted to do, that will be interested in this space. We'd love to hear where you're at in your advisory journey and to share war stories with you. Indeed, as a profession, we can learn a lot from each other. If you come to the demonstration session this afternoon and the same one again tomorrow, you'll actually see real clients. Every client we have in Profit Guardian is real, just that the names are unreal. Although there is one real name in there, and that's ABC Learning Centres. And it's ABC Learning Centres that forms the core, the focus of our demonstration sessions. And we actually did ABC Learning Centres because we thought, I wonder how Profit Guardian would go on a well-known multi-billion-dollar company just for fun.